Bringing Morgan Stanley senior research analyst Betsy Graseck joins us on the Newsline. Betsy, thanks so much for joining us. Actually, before we get to the earnings per se, I wanted to just dip into a great research note you guys put out recently, which analyzed exposure of the banks to the counties across America that are seeing the biggest spikes in COVID cases. Of the big banks, which stood out to you as having the worst exposure in light of this news that LA is shutting down various parts of its economy again?
Yeah, so that research was led by Ken Zerbe, our mid-cap bank analyst, and myself. Out of the big banks, B of A, JP, Wells, they all have exposure to these counties. B of A is most exposed as a percentage of total. Now, importantly, that includes their corporate deposits as well. That's just a highlight. It's corporate and consumer. But importantly, as a percentage of total company, the mid-cap banks are really more impacted because they're much more, as a percentage of total exposed to these locations. But for my names, B of A has the most dollars of deposits in these counties.
And so pivoting forward to earnings kicking off tomorrow, I guess the question on everyone's tongues is whether or not this is going to be the peak of provisions of set-aside money for bad loans this quarter. What's your expectation there?
Yeah, Wilfred, that's exactly right. And that's our expectation that we see the largest increases in reserve build this quarter for the group overall. I mean, some companies are going to be lower than first quarter because they didn't put like a fiscal overlay on top. That's Ally. But for most of our names, we expect 2Q reserve build to be pretty close, if not higher than 1Q. Look, we're going to have really strong trading revenues. We're going to have very strong mortgage gain on sale revenues. And in our models, what we're doing is we're putting all of this into reserve build. And that's why we're below the street for most of our estimates. But it's really messaging a view that the management teams will be conservative in trying to build reserves as much as possible.
So, Betsy, with that in mind, who is best and worst positioned given the stock setup into earnings?
So, in terms of the stock setup, we look at what's priced into these names. And I look at somebody like Ally Bank. Ally is one of these institutions that has reserved dramatically in 1Q. So they can actually have a reserve in 2Q that's lower. And it's, priced like a 17% cost of equity. What does that mean? It's trading at, less than, close to half book. It's basically on a 6 times 2021 earnings estimate. This stock doesn't make any sense to me. It's our top pick going into the quarter. Out of the money centers that are going to be reporting tomorrow, frankly, Citi's our top pick because same type of thing. Their valuation is so low, only 7.5 times 2021 estimates. So we're really looking at the valuations of the companies when we're answering that question.
Betsy, these stocks kind of peaked in early June. It was at or around when you had your Morgan Stanley Financials conference, and the tone that came out of that conference was really quite positive. Obviously, since then, we've seen a worsening in cases across the Sun Belt. Even if that didn't quite capture in the numbers, given that, of course, the quarter ended at the end of June, if the tone of the commentary on the earnings calls is quite a lot worse than what we heard at your conference in early June, do you think that could take 10% out of these stock prices? How big a swing factor could that be?
So it's a big hypothetical here, Wilfred, as you know. But I think what you're going to hear the management teams talk about is what's going on in the books. How much is forbearance? How much delinquencies are increasing? And what does the percentage of folks that are in forbearance actually paying their loans, how has that changed? So I think we're going to get a lot more information on the quality of each one of these companies' books because we have a full, another quarter and a half or so in the bag in this, unusual economic environment we're in. So to your point on caseloads increasing, does speak to a concern about the pace of the recovery. But when we look at the facts that are out there today, unemployment is lower today than it was in June at our conference. And obviously, I think that's going to be the driver. Now, to get a, one-time 10% decline in the stocks, I think takes much more negative expectations than the caseload increases that we've seen today. Not that I, like seeing those kind of caseload numbers, but I'm just highlighting I think you'd need to see something worse than that.